Blackboard. All right, questions before I start? And feel free to interrupt at any time. So first exam in investments, we're covering all the way through that beginning part of 6. You'll see the slides as far as we went. I won't test you on anything that has not been covered. Future exams will be cumulative, so you'll be responsible for all of this. And if you look at the past reviews on YouTube, you'll see all this covered. So I've got almost identical slides because it's the same content every year. It depends on how far other classes are. Y'all are a little bit ahead of where I was last year for exam 1. Normally there's more time spent on time value of money, but y'all were all able to do the calculations, so we moved on. So it just depends where we're at. Okay, so 5 true false questions, 2 short answer. I mentioned that Barron's is you reading any article of your choice. You're going to give me the title of that, you're going to summarize it, and you're going to apply it. You'll get full credit. So you can prepare that ahead of time. You can't write it down ahead of time, just have it in your mind, be ready to write it down. And then the one choice is going to be with those 5 true false, those 2 calculations, and the 10 multiple choice, something that was not covered. I feel like with 10 multiple choice instead of 10 short answer, now that I look at that, it's going to be really easy to get that in time. Huh? We'll see. We'll see. I'll try it with this time, and then maybe do a mix of short answer and multiple choice. But something that fits the 50 minutes rather than the hour 15 I've been used to. All right, so portfolio construction. We are looking at all the dollars that we receive, and we are spending them or saving them. Those dollars we receive could be income, they could be gifts, they could be our interest, our dividends, whatever. So we're either spending it or saving it. Saving, we look at all of what we've got as our investment portfolio. It could be the dollars in your purse, it could be in your checking account, savings account. All your dollars can constitute your portfolio. All that combined, we want to be diversified. The way we put that together depends on the investment goals that you have or your client has. So I may have an emergency fund need. If I have an emergency, I want to be able to get those dollars quickly, so I'm not going to put an emergency fund in a Roth IRA. I want something that I can immediately grab. Checking, savings account, money market account, something like that. If I have, like for that Roth IRA, retirement goals, I might want to put it in those tax advantaged accounts, the Roth or traditional IRA, my employer sponsored plan, whether it's coming with a Roth or traditional flavor, and how I'm able to choose where I put those assets within it. Not all assets are appropriate for all financial goals. 529, very specific to the goal of paying for college. That's not going to be a suitable investment vehicle for retirement. So I'm looking at which types of accounts I do have access to. So I might not have access to a Roth 401k through my employer. I might just have a traditional 401k. If I have a Roth 401k, then I have to have if I have a Roth 401k, I must have access to a traditional 401k. But if I have a traditional 401k, it doesn't mean the employer is going to offer a Roth option. Other goals we might have: buying a house, going on vacation, things that will be short, mid, or long-term goals, and those can change over time. Maybe I no longer want to go scuba diving in the Maldives anymore, so that goal could change. Now we want to do something else. Maybe I want to retire earlier or later. Maybe there's a birth or a death. With that diversified portfolio, I'm meeting the client's risk tolerance, when they're going to freak out, their risk capacity, how much they could afford to lose. So even if they're ready to bungee jump off a cliff with all their dollars, if it's going to cause them to be in financial ruin, if that bungee cord breaks, then I don't want to do it. That's the capacity. If they've got plenty of room, we could take on more, but if their risk tolerance is going to have them freaking out when we lose $5,000, even though that's not going to impact them at all, we have to take that into account. So we're trying to match what the client's goals are, their risk tolerance, their risk capacity. If we have a couple with differing tolerance and capacity, we got to think about how we're going to put that together to recognize that this is a household and not just two different individuals. So why are we investing? We want to make money. So the goal of all the investments that we're making, that other people are making, as far as this class is concerned, is to make money. There could be altruistic, where I am investing in the children of Alabama by donating to Savings Kids Funds or something like that. But we're talking about investments as investing to earn money for whatever goal, retirement, for whatever, but we're trying to make some dollars. That goal is going to be clear. I already talked about the emergency fund and where we would put those investments so that it would be liquid: checking account, savings account, money market account. Finance education, I mentioned the 529. A Roth IRA could also be good. It would offer more flexibility as far as where the person could spend it. And we now have some new accounts that are kind of built on if you went to the symposium, the chassis of IRA. So most likely that Trump account will be like a Roth IRA for children now, where you can put dollars in even though they don't have income. Specified purchase, the home, when do we want it? 10 years from now, 5 years from now, whenever, when do we plan to retire? We'll get into mutual funds in a little bit, different types. Those target date mutual funds would allow you to plan pretty easily for a client that doesn't want to mess with all these dollars, and it automatically rebalances. So we want that portfolio to be appropriate to their goal and their time horizon. Time horizon changes as we ages. So as we ages, we go into the ups, and we're closer and closer to retirement. So if I'm about to retire, I don't want to take on the same risk as I did when I was 20. If I'm trying to retire at 60, by age 57, 58, this portfolio is going to look very different than it did when I was 20. Target date funds automatically rebalance those accounts to be more aggressive. The longer the time horizon it is to whatever that target date will be. And once we've reached that target, it's going to be very conservative. As we approach retirement and are in retirement, we're much more conservative because we're no longer trying to grow a lot of our wealth. We're trying to keep it stable so that we're not eating cat food in retirement. With stock, we are buying into a company. We share in their fortune, we share in their failure. So they do well, awesome, our stock is worth more. We have that appreciation. Hopefully, it could have gone down, it could have failed, which is the price I paid and then the price it's worth now. If the price it's worth now is up, that's appreciation. It's a paper profit until I actually sell it. Any dividends that I receive while owning it, that's part of my return. So all the dividends plus the appreciation, assuming I've sold it, are my return. With the stock, I get to vote. For every share that I own, I get one vote in this publicly traded company. Note that most of the shares in publicly traded companies are owned in mutual funds, which are owned in retirement accounts by individuals owning a mutual fund, but the voting rights of all those individual shares belong to the company. Vanguard, Fidelity, TIAA-CREF, Schwab, whatever that company might be, they're voting those shares on your behalf-ish. They're voting them to make money. So it's still kind of achieving the same goal. So your investment in publicly traded companies as an individual, your votes aren't going to really move the needle unless you own a significant chunk of that publicly traded company. With bonds, I am lending. I am lending money to the government or some entity. And I say the government, any government. It could be Japan, it could be the United States, but I'm lending them money, and the bond itself, there's going to be a contract called a debenture that's going to state exactly what I will receive in exchange for lending them money. The riskier it is, the less likely I think I'm going to get all this back, the more they're gonna have to pay me to incentivize me to loan them money. So typically we look at this, and there's different amounts that we can put in bonds. You could loan $100,000 to the US government, and they're gonna pay you back, instead of a dividend, a coupon, my interest payment over the time I'm holding it. When the bond matures, I get my money back plus a little extra. There are zero coupon bonds that just, I lend them $1,000 and they pay me $1,200 at the end of the term. All that's gonna be spelled out in the bond, and with bonds, I'm more secure. For most of them, they're gonna sell their assets in order to pay me back. With the stock, if the company doesn't do well, if it goes bankrupt, I get nothing. If a company goes bankrupt, but I lent the money, I have this bond, I'm gonna be in line as a creditor, and some of the assets they sell, they're gonna make me whole. So there's no obligation to make stockholders whole as far as getting back their initial investment. That's the risk we took on. With the bond, for most of them, some could be based on revenue, some could be based on other things, but for the most part, bonds, there's more of a guarantee I'm gonna get my money back. The more that guarantee, so we got our risk-free rate of the US T-bill, we feel very confident we're gonna get those back. I'm not gonna get as high of interest rate, my coupon's gonna be lower, I'll make less money than if I were to lend to some small company that doesn't have a track history, or has gone bankrupt before and come back and is owing lots of dollars around. That's more risky, so I gotta get a higher return. If I take on greater risk, which is the uncertainty associated with will I get money or not? So I don't have a crystal ball. Anytime I invest, whether it's buying stock or lending money as a bond or whatever the investment might be, I'm taking on some risk because I don't know what's gonna happen in the future. I might not get that money back. The government could fail, the bond may not pay out. The more risk I take on, the more return I expect. And notice expect is in all capital there, because that's what people tend to miss when I ask this. It's expected return. There's no guarantee of future returns. I'm taking on additional risk because I expect more return. Otherwise, there's no incentive to take on that additional risk. All right, so we've got different ways we can invest and different people that are in this market. So looking at the market maker, they have what's called the spread, the difference between what they're gonna pay you and what they're gonna sell it for. The greater that spread, the more money they're making off of this transaction. We have brokers where they're going to give you recommendations on things to buy and sell. There's going to be some conflict of interest with some brokers where they may get paid a commission if you buy or sell. They may be incentivized to sell certain things, certain assets. But because they are paid, whether you invest in that incentivized asset or not, they're paid for you making trades. Because that brings money into Merrill, where I bought 100 shares, I'm paying a fee for doing that. I'm paying a fee for the advice. So they may want you to trade more often than is good. Those trading fees eat away at your return. If we're gonna day trade, if we're gonna do crazy things like that, we wanna do that in a Roth or in a retirement account where I'm not paying the fees and I'm not paying the taxes each time. Discount brokerage firms where they're not giving me any advice, E-Trade, Robinhood, something like that, where I'm just going in and I'm saying buy, sell. That's something that did not used to exist. More people have more access to the markets through these free trading platforms, or very discounted. Within, as I mentioned, like the Roth, if I'm gonna buy, sell things, I'll do that in my Roth IRA more frequently than something else. Because if I do that in a brokerage account, I have to worry about capital gains. If I haven't held it for a year, capital gains are going to be short term, meaning I'm paying ordinary income taxes instead of long term, which would be 15% for most trades. I mentioned you could potentially pay 20 or 0 based on your income, but most people are going to pay 15% on long term gains. Okay, so we have long and short. If you're a bull, you think the market is generally going up. If you think a bear, you may not necessarily think it's going down. You probably think it's going down, but you might also think it's going to stay flat. Bears, we're going to hibernate. We're going to wait it out. Maybe we're going to buy when we think it's low, because now we're bears. We think it's going to come back up. I'm sorry, we're bulls. We're coming out of our cave and turning into bulls so that we can make money as it goes up. Hard to time that. So when we talk about those economic cycles, we don't know where the peak is. We don't know where the trough is. We're doing our best, and that's part of the value that you provide as somebody's financial planner. You're creating that diversified portfolio that meets their needs, and because you match it to their risk tolerance and capacity, they're not freaking out when the market goes down and trying to sell everything in the down market. They are able to stay the course and recognize that we are investing for the long term, and this is the plan. There are going to be bumps, there are going to be fluctuations. Sometimes you'll have a down year, sometimes you'll have a down quarter, but overall, we hope this is all going to have a steady trajectory up. Market orders, market limit, I am saying I'll pay the market price. Whatever the cost of this stock is, I want to buy 5 shares, 7 shares, 5,000 shares at market price. That's going to be processed pretty much right after I press the button. So I can go into within my Roth, within a brokerage, within whatever, and say I want to buy this many shares of this stock, of Google, of whatever, and I press buy for market. It's going to buy it as soon as it processes it. We saw that random walk. What I tend to do is I'll go with the limit and I'll put it just a little bit, like 1% or less than 1%, less than what it's trading at right now, and hope that the random walk throughout the day goes down just a little bit, and so I get a slightly less. Doesn't always work. Sometimes it just goes up and I should have bought it at market because it would have gone up. I can set that to last for the end of the business day, for a month, for 60 days, until I actively cancel it, which if I decide I don't like it anymore, if I set it for 30 days, I could go in and say, okay, I don't want that one anymore. But I'm setting it to go for 30 days, and then I can go scuba dive in the Maldives or whatever and not worry about it. And when I come back, it will have made that buy if it ever hit the price that I wanted. This can be for selling as well. I can sell at the market price, saying that whatever it's going for, I just want to sell 100 shares, and it's pretty much immediately going to be processed. If I instead want to do the market, I'm going to say, if I want to do a limit, I'm going to say I don't want to sell it unless it's this price. So if it never hits that price, if it always stays under, I don't sell. My account won't sell. Margin, I am going to borrow money from Vanguard or whoever I'm doing this with in whatever account. They're going to lend me up to 50% of this purchase. So if I have $10,000 and I want to invest it in this thing, I could set up this margin account, and they're going to run through some things, and I'm not going to be able to do this immediately. But once I've satisfied whatever things they need, it's going to vary a little bit by different companies. They're going to say, all right, cool, you're going to put $10,000 in it. We'll also put $10,000 in on your behalf. I am now able to put $20,000 into this investment instead of 10, and I'm able to, with that other $10,000 minus whatever interest that I'm having to pay them, invest in other things. If this pays off, awesome, it sells, I get the dollars, I pay them back, we're all good. So the $10,000 that I had invested in it, and then the $10,000 they had, or I borrowed from them, I get all the profit from their $10,000, they get their $10,000 back, plus whatever interest I paid. So they're a winner no matter what. It goes down, and I've got less than 25% in there, they can do something called a margin call. That 50 and 25, those are set by the government. Vanguard, Fidelity, somebody, they could be nicer. They're probably not, unless you've been doing this a lot, and they might let something slide because you're regularly putting $1 million plus through their accounts and doing these margin things. They make lots of money off you. They want to kind of keep you happy, but they can't be any meaner than the 50-25. They have to at least set the 50-25.
Wait, so what are stop orders?
Stop, I'm saying no longer sell it at this price. So I can say like, I want to go with the market until it hits a certain thing, and they'll sell it throughout. Those are more rarely used. You're going to see more market, more limit. You might use margin, but for most clients, we're probably going into mutual funds, dollar cost averaging, and not trying to play with the day-to-day. If we're outsourcing our investments to a third party, they might do that playing around day-to-day type thing. But with the comprehensive wealth management, with what you'd be doing at a firm like that, you probably wouldn't be buying and selling throughout the day. There'd be, it's like I remember we spent like 2 days buying gold for a while because the owner thought that the gold was going to do well. And so we were putting all our clients in gold. So for 2 days we were like, she would find something to sell from their account and we would sell it and buy the gold. But normally you're not doing that. The margin increases risk because if that does go down, not only did I lose my money, but I have to pay Vanguard their $10,000 or however much I borrowed. Regulation, we have 1933, the government said, okay, for all new offerings that are going to be on this publicly traded market, you, the company, need to disclose all of your financials. We want to know where everything's invested. We want to know what your plans are. We want to know all this stuff, and you're going to make it publicly available. We have that shelf registration. So if I'm a potential investor, if I'm interested in this new public offering, I can go on that shelf thing like a library, but it's digital, so 1 billion people could check this out at the same time, and we could look at all the financials of this company. Come down to Sarbanes-Oxley. We can't always trust these numbers. Sarbanes-Oxley is the idea that we should be able to trust the numbers because now we have to have outside auditors come in, and the CFO, president, CEO, they all have to sign off saying, yes, I agree with these. Sarbanes-Oxley came about because of Enron. We watched the video on that where basically they were acting as if they were already receiving income that hadn't been received, and they were projecting it. So they project income into the future that had never been bought. They're dealing in energy, and acting as if that was revenue, that was an asset already in their books. So it made them look really good. Outside investors, awesome, happy, great place to work. It was growing real fast, but it was built on all those projections, and it eventually caught up to them where the top 3 guys got arrested. I think 2 went to prison, 1 died before he went to prison. But the ordinary workers, the ones that weren't up there in the know, they had their retirement invested in the company and they worked there. So an example of don't put all your eggs in one basket. So diversify both your work and retirement savings. Some things, like my mom worked at Exxon, she got a 15% discount on Exxon stock. So she had a pretty good chunk in Exxon, but after a year or so, I would have her sell some of that out and buy something else so she wasn't 100% in Exxon. In that case, she probably would have made more if she was 100% in Exxon, because Exxon did great while she was there. But it, on that risk-adjusted basis, was better for her to have the diversified portfolio. Securities Exchange Act of 1934. Oh, actually, let's go back to that IPO on 33. Initial public offering is the IPO, and we've got that shelf registration. Usually some sort of investment banker is going to put that together, and they are going to tell this company that makes new medical technology, they're not experts in the market. They're relying on this investment banker to put all this together for them and make sure all their paperwork is correct. What the investment banker is going to do is they're going to say they're going to do this one of 2 ways. Either best efforts or guaranteed. Best efforts, they're going to try to price this accurately, sell it on the market to the general public. Guaranteed is if those don't all sell, investment bank is going to buy it. So whatever shares don't go to the public, they will buy it. With best effort, the company itself the company going public would have to eat that loss. They would have to, well, I guess I have these extra million shares, and the ones that sold only sold for $1 instead of $1.50, whatever the thing is. So all that information had to be available in 1933. 1934, Congress said, oh, we should also do this for all the existing companies. So basically the same thing. This is what we saw when we went into Edgar. They have to file an annual report, quarterly reports. If basically any executive buys or sells any of the company's stock, that's publicly reported. So all this is there quickly. The annual report once a year, quarterly once a quarter, but when any CFO or somebody sells $1 million worth of this stock, that's going to be reported. And it could be they're just trying to buy a yacht. It could be that, you know, they see the writing on the wall, this is going to go down, so I want to get my dollars in now. Investment Advisors Act of 1940, we talked about this idea of, is a investment suitable for a client? So this isn't quite the fiduciary standard yet. That comes later, but it's the idea that you need a suit. I'm gonna get you a suit, but I might have got you a tuxedo to go to a funeral. For the fiduciary, it's the right suit for the occasion. So it's what's best for the client. Oops, sorry. Time value of money. We had that big takeaway of $1 today is worth more than $1 tomorrow, because we have inflation eating away at the purchasing power of every dollar. And we saw that when we went to the Consumer Price Index created by the Bureau of Labor Statistics, where they create this basket of goods, these groceries, and we can dig into specifically what is beef doing, what are eggs doing, what is gas doing, what's housing in a specific metro Atlanta market. Compared to a year ago, to 5 years ago, to whatever time period we're looking at, as long as it's in their records. It doesn't go back forever. With our time value of money calculations, we went on the calculator and we had our 5 inputs. In the time period, and we saw we may have to change that to monthly, 12 periods per year, or 1 period per year, and that's something that you have to manually change. If I clear time value of money, whatever the periods of year were that I had set, those stay until the battery dies. IY, that was our interest rate, could be interest I'm receiving or that I'm paying. I bought a car, so that interest rate, this is how much is going to go towards it. PV, present value, I can discount future cash flows into present value. I can compound present value dollars I have today in an account to future value, FV. PV and FV will always be opposite in sign. If you get an error on your calculator, you probably had it both as positive or both as negative or something. Conceptually, if a dollar comes out of your pocket, it's negative. I do it with whatever's going to make me put the fewest number of keystrokes. I'll just know that this negative 5,000 is actually, it grew to 5,000 positive dollars. The payment is going to match one of those. Kind of depends on what I'm doing. If I'm saying I have $10,000 in an IRA and I'm going to put $5,000 every year into that, those two are going to match, and then future value is going to be opposite. So I'm investing, here's the $10,000 in it, and then I put another $5,000 into that account. It grows to whatever amount. It may still be in the account, but it's going to come out negative on the calculator. Annuity versus annuity due. This is the end mode versus begin mode. Annuity due, begin mode. If I say the payment starts at the beginning of something, begin mode. What that means is if it's an annuity due, I receive the payment at the beginning of whatever that period is, annually, quarterly, monthly. I receive it day one. If it's in mode, I don't receive it until the end of the year. It's like when you do retirement calculations, you want to make sure that your clients are going to start taking dollars out at the beginning. We don't want them to have to wait a year before they actually take dollars out of their account. All right, talk about their objectives and goals. Just like in financial counseling, for financial planning, we are going to look at their balance sheet, statement of net worth, assets minus liabilities, their income statement or cash flows, all the dollars coming in, dollars going out. Diversification, I've got another slide on here that has the table. You'll need to be able to list all those. We had our diversifiable and non-diversifiable risks. The things that we can diversify are the business and financial. The things that we can't are those primes. And right now you just have to list those out. You could draw the chart if you wanted, but exam one, you just have to list them out. As we go forward, you'll have to draw it, you'll have to explain more things, but here you just have to draw it. 12 to 15 different types of assets for our business and financial risk that we can diversify away. We're accepting that we're taking on risk otherwise. Capital gains, we only have capital gains or losses once we actually sell that asset. Gain or loss, doesn't matter how much I received in dividends. So I could have held this $100 asset and it's worth $90 now, but in the time I held it, I received $60 in dividends. We're still gonna have a capital loss because it's just looking at what I bought it for and what I sold it for. With gains, I can reduce those by loss. First, we match short-term to short-term. Short-term capital gains are gonna be taxed at my ordinary income rate or your client's ordinary income rate. Long-term at 15%, we'll say. And I mentioned that 20 or 0. Losses can offset gains. So we go short to short, long to long, then we mix it up and go short to long and then long to short. And try to do our best to help the client not pay taxes. So it's automatically set up that way. These are all also going to be FIFO, so the first dollars in are gonna be the first dollars out. So if I bought something last month and then sold it this month, could be long-term if I also bought it over a year ago, and that's all I sold. So I bought Google stock 5 years ago, last month, and then sold some today. It's gonna go if I bought it 5 years ago, and those are the ones being sold first. Tax shelters, we talked about the tax advantaged accounts, the Roth and traditional IRA, the employer-sponsored plans, whether they were Roth or not. Municipal bonds, different types of bonds through the government. We have the HSA, where I'm putting after-tax dollars into it, but I'm limited. So pretty much all these tax advantage accounts are gonna be limited in how many dollars we can put into it. But the HSA after-tax dollars go in, and it grows tax-free. I have to use it on medical expenses until I get old, but after that, great way to save for retirement, especially when you're young, if you can afford the high deductible health plan. Go with the HSA, put the dollars in, and you're probably not gonna need it, and you can invest that however you choose to invest it, and then pull it out when you need it. You're not gonna have to worry about any capital gains or anything's on it. Efficient markets, I'll have a chart in a minute. You'll have to recreate that chart just like you did on the quiz. Big takeaway, you can't expect to consistently beat the market. In a semi-strong unless you have insider information. In a weak form, insider information and some analysis. Strong form, we just can't at all. Active versus passive. Active investing, I'm talking about either buying all the stocks on my own, figuring out what to do, but generally we're thinking of mutual funds. A mutual fund that is not an index fund. That means I'm paying higher fees. That means that the company is having to hire lots of people, all these experts, maybe they're traveling, maybe they're paying third-party consultants, whatever, to decide what to buy or sell within the mutual fund. Those are gonna be probably sector-specific, healthcare, something, where the index funds are just matching an existing index, and they're going to be no fee or very low fee. So there's our efficient markets. Life cycle hypothesis, I've drawn that on the board. The idea is you get that job when you first get out of school, immediately start putting dollars in the retirement plan because you won't feel that loss. It's as if they were never there. I want to smooth my consumption through my life. I can go up and be happy, but if I go down, even if that down is still higher than what I used to have, it's going to hurt. So we want our clients to be able to smooth consumption over their lifetimes. That ability to borrow and bequest motive, those are a couple of weaknesses of the life cycle hypothesis. It assumes that everybody has the ability to borrow, to take on the student loans, to buy the equipment they need for their business or whatever it is. and it doesn't take into account a bequest motive. It's as if you just want to die with $0. Talk about the net worth balance sheet and their cash flows. If it's expressed in the present, those are actual numbers. They're actual dollars that are happening or have happened. If they are forecasted, we are projecting this is what you're going to spend in retirement. The more care we take with that, the more accurate our projections will be. And we're going to adjust them over time. They have an illness, they lost their job, they're whatever. We're not going to project their future dollars to be the same. Capital gains I already talked about, paper profits as well. That may hold an asset indefinitely and postpone capital gain taxes. That'll hit on some estate planning things where I want to give the highly appreciated asset to my nephew. He's young, he's got more time for it to grow because he takes on a new basis. It's not the basis that I had when I first bought it. It's whatever this investment is worth. I bought it for $100,000, it's worth $5 million. He gets it at a basis of $5 million, if that was what it was worth the day I died. Analysis of resources, we want to know what the client has, what they can get into. If they don't have, for some reason, the ability to get into a Roth IRA, they earn too much, we can do a traditional IRA. We can backdoor our way into a Roth. If they have an employer that doesn't offer a retirement plan, we've got to figure out a way to save for retirement on their own. And those Roth IRAs are going to be limited in how many dollars we can put into it. Putting together a plan, making adjustments as we need. As conditions change, that was that. They got divorced, they had a baby, they got married, they got a raise, all these different things that could happen. They lost their job, they received an inheritance. We're going to adjust the plan when things like that happen. But we're also going to reevaluate at least annually. And here are those things for our risk. I won't ask you to draw it yet. So this exam, we really just need to list it. Systematic, we had primes, our purchasing power, reinvestment rate risk, interest rate risk. That's the tricky one. Purchasing power sounds like an I because it's inflation, but we're looking at interest rate risk for the I. Market risk, exchange rate risk, and then the sovereign risk. So right now you just have to list those along with the things that we can actually diversify, the unsystematic, business and financial. We diversify by not having perfectly positive or perfectly negative correlation. We have different things. If it's perfectly positive, everything's going up. If your entire portfolio is going up right now, you don't have a diversified portfolio. So we want a mix of things so that when these things go down, we're not taking as hard of a hit. It's that idea of risk adjusted, this diversified portfolio will help us long run. With our standard deviation and beta, we are starting to look at how much risk this specific asset or portfolio has. And then we get into our calculations with that. Arbitrage was taking advantage of pricing differences from one market to another. Because people do that, those prices are reflected very quickly. Terrible way to make money. People almost always lose money trying to arbitrage because you're also paying fees and capital gains. If you're going to try to play with that, do it in a Roth IRA or some sort of account where you're not paying fees and you don't have to worry about taxes. Mutual funds, that was that big Santa sack of different types of investments within it. Could be a mix of stocks and bonds, could be focusing on one sector, could be actively managed where they're doing all that research and we're paying fees because it takes them time and effort to do so. Or it could be the index fund where they're just mirroring something and we're not paying a fee for that. The loads could be front end load or back end load. Front end meaning I'm paying a little bit extra just to get into it. Extra meaning above the net asset value. Back end load, I'm paying a little bit extra when I sell it. I can make that disappear usually if I hold the asset long enough. So then the back end load reduces or goes away altogether if I hold it for long enough. Mutual funds invest in pretty much everything. They're passing the taxes on to me. Doesn't matter if it's in a Roth, doesn't matter if it's in a traditional IRA or a retirement account, because I don't have to pay capital gains yet. So they're passing those on to me. This matters in a brokerage account. The brokerage account, I'm gonna have all this stuff where I'm paying probably long-term capital gain. You're almost always paying long-term capital gain on dividends. It rarely happens that you wouldn't. You have these calculations, examples of in Blackboard. So that was that Excel file I was talking about. You can go in and do any single one. Actually, you do all of them at once. Alpha, we have our portfolio minus, and we just saw that formula that was on the CFP board formula sheet. That's the capital asset pricing model. So my portfolio minus all this. I should have at least got the risk-free rate, which I'll give to you. Plus, now we're going to take into account the risk that I took on, return to the market minus the risk-free rate times the beta of my portfolio. I won't tell you the beta of the market, that's 1, which will come into play in Trainer. Beta of the market, I need to compare the Trainer of my portfolio to the Trainer of the market. If mine is higher, cool, on a risk-adjusted basis, I outperform the market. For Sharpe, almost the exact same formula, but now my denominator is standard deviation. And when I compare it to the market, Trainer and Sharpe, I have to compare it to the market. If you just do one, I'm going to mark it completely wrong, because you can't interpret it. It means nothing. With Alpha, you just got to do it once. If it's positive, you outperform the market on a risk-adjusted basis. You may have the same exact investment that in some of these will come up as you outperformed and another comes out as you underperformed. So it depends on what we're setting up. Sharpe, we don't assume it's standard, a diversified portfolio, so we use the standard deviation as compared to beta. Already told you your Barron's, and that's it, just in time. Questions? All right, roll tide.